name is Adam Greenfader. I have the pleasure and honor to be with Ian Ward of Guy Carpenter, Senior Vice
Hey,
President.
thanks, Adam. Appreciate it, and I'm glad to be here. As Adam said, my name is Ian Ward, and I work for Guy Carpenter. We're one of the largest reinsurance brokers in the world. We have offices globally. I moved over to Miami around 12 years ago from London. I've always been involved in the insurance and reinsurance industry for 34 years now, and specializing in the Caribbean since 2001. So I look after clients that are based in Bahamas, Cayman, St. Martin, Jamaica, all the way down to Barbados. So it's very culturally diverse in terms of the islands that I work in, but very similar issues and very similar challenges that we face in terms of raising reinsurance capacity for the local insurance companies to run and to operate.
So, Ian, I guess just to start us off with a real simple question, what is reinsurance? I mean, I know we all have different definitions, but if you could just start us off, what's that mean?
Well, I think the easiest way of describing it is insurance of insurance companies. And every insurance company will build up a portfolio where ideally they want to have as much risk in as much policyholders as possible, so that they can work with the law of large numbers and say we can accurately evaluate and accurately work out roughly how many losses we're going to have in any one year, and the process being that the premiums of the many pay for the losses of the few. And insurance companies work on exactly the same basis. They can maybe cope with a handful of fires every year, but certainly if a hurricane goes through, that impacts tens of thousands, if not hundreds of thousands of their policyholders. And at that point in time, they do not necessarily have the finance and the capital and surplus in place to be able to cope with that large number of claims. So they look to risk transfer outside of their own industry into the reinsurance industry. And the reinsurance industry is global. We deal with companies in Europe, North America, South America, Asia, and it allows that kind of diversification of risk and that spread of potential loss into international markets, which are far bigger in terms of their capital base than a local insurance company that maybe operates in a single island or a single territory.
How large in terms of dollar value or euro value are reinsurance companies? I mean, what kind of money are we talking about?
I mean, we for all of the companies added up is somewhere in the region of 560 to 570 billion US dollars.
Okay. And then just to be clear, so what your company does and what you do is you connect between these reinsurer industry and the insurance industry. Is that correct?
Yeah, exactly. Yeah, exactly that. In the same way that if you look to insure your home, that there are direct insurance providers, but typically you go through an insurance agent because they have a greater degree of expertise in knowing where to place your risk. So exactly the same for reinsurers. We have access to more global markets than typically an insurance company will be aware of. So it's easier to work through an intermediary and a broker to access as much capacity as possible.
Through kind of what 2024 looks like in the global reinsurance market in general. And we're talking mostly focused at the real estate and catastrophe insurance, if that's okay.
If you kind of review maybe the last 15 to 20 years, reinsurance capacity increased steadily, single digits, year after year after year, until 2022 when it dropped. So we've had that dip, and we're now starting to see it go back up again. It has made life a lot easier in 2024. We're seeing a settling down in terms of price increases. We're seeing a lot of stability in the market, and we're now starting to see a return from some investors to look to reinsurance as a product. And starting to see the level of capacity creep back up.
Kind of moving on that subject about environmental risk and insurance and reinsurance. So obviously, a lot of my listeners are Caribbean-based focused. Where AG&T, we're based here in Miami, Florida. I know you're based in Florida as well. So there's a lot of environmental risk that's around us. in some cases, a lot of local insurance companies in Miami, I understand, in 2023 closed and had to leave the state. And then after Surfside, a lot of new regulation has kind of tightened up the HOAs and specifically insurance requirements. So, kind of how are you seeing this relationship now in this new climatic environment we're in with insurance?
Well, I mean, we're taking a very close look at it in terms of how we view the climate risk. And I think it's fair to say that there has been a shift in terms of what we're seeing from patterns, particularly through the hurricane season. There's been a lot of talk of maybe having to have a new classification of hurricanes that incorporates a Cat 6 storm, just because we're seeing rapid intensification of storms. We're seeing much higher wind speeds. We're seeing larger storms coming through the Atlantic basin. Whether or not that's a cyclical trend, or whether that's something that is a kind of a start of a new era of storms, we don't know, but it's something that we have to take into consideration. And certainly when investors in the reinsurance industry are looking to provide capital, they're taking this into consideration and pricing for it accordingly, because at the moment there's not enough long-term data to demonstrate whether or not this is a 2 or 3 year thing, or it's going to be a 20-year thing. And certainly with kind of urban development and a higher concentration of value of risk, a storm occurring today, which was exactly the same as 20 years ago, is going to cost exponentially more than it did 20 years ago, just because of the sheer concentration of risk value.
So by adding more density as we naturally build up our urban core, that adds additional risk from an insurance perspective?
Absolutely, absolutely. And it's one of the things, you kind of have a little bit of a miss factor with a storm. A hurricane comes through, not every single building gets damaged. Not every single building gets damaged in the same way. But if you have within a square mile radius 5 buildings, and then 20 years later within that same radius you've got 20 buildings, you have to appreciate that the damageability is going to go up. There's going to be less of a miss factor.
How do you see the Caribbean region kind of facing this?
I think there's actually 2 things, and you touched upon the rebuilding after storms, and certainly I think we've talked about this before, but immediately after a storm there's a lot of lessons learned. I think there's a real sort of misconception that across a lot of the islands the building codes are not particularly strong and are not particularly sophisticated. But what they do is take a look at sort of post-loss damage and say, that particular roof fared really well at these type of wind speeds, or that particular type of construction fared really well at those wind speeds. And you see a massive improvement in sort of reconstruction style post loss.
From an insurance perspective, does that data or information or understanding affect whether insurance companies want to come to an island or a particular location?
But what we've started to encourage our clients to do is to really sort of provide that granular level of detail and really drill down into their underwriting philosophy to actually sort of find out what type of construction has been used, whether or not they had a loss from previous storm, so that when we're presenting their data and their information to the reinsurance market, when we're looking for capacity, we can maybe differentiate our clients or differentiate portfolios to say, look, you have maybe a more of a macro view of the type of risk in a particular island, but we can actually drill down and say, look, in actual fact, this is the type of construction that typically our clients will look to insure. And as a result, we would expect their anticipated loss to be lower as a result of this. And we run through CAT models and provide them with sort of expected probable maximum losses for certain storm levels. And it's trying to educate and trying to sort of have a higher level of understanding of risk. What we found, if you leave people to make assumptions, pretty often their assumptions are wrong. So what we try to do is eliminate as many assumptions as possible so that they're making informed decisions, which, as you know, as an investor, the more that you can make your decision making process on actual quality data and informed information, you have a much better idea as to where and how you want to invest.
Yeah, that's just a brilliant point. And we've always said information is power. Everybody knows the saying. It's just simple. Just more
Absolutely.
information, better decision, assuming that information is good. There is concern, especially in the less developed islands, that insurance just is not going to be available at a cost of, at a cost, it'll be a cost prohibitive. And so for all intents and purposes, the insurance will not exist the way that people have been used to it.
I think there's a finite supply, to be perfectly honest. And certainly a finite supply when it comes to an affordable price. And, part of our job is obviously to advocate on behalf of our clients, but in doing so, we also advocate on behalf of the general public in terms of their original policies. And we've had conversations where a certain reinsurer said, well, I think the man in the street in Barbados or wherever should be paying this amount for his homeowners, because that's how much we want in terms of our returns. And we turn around and say, well, that's double the current market price. At a certain point in time, that man in the street is not actually going to be able to afford that. So you have to kind of rebalance your view of risk as a reinsurer to say, well, look, okay, there is a tipping point where all of a sudden the product doesn't become, or it becomes unaffordable. And it's not really, it's not just about the annual losses that companies suffer in the reinsurance industry. It's also the investment environment. And there was concern that with the Fed putting interest rates up in the US, that was going to pull capacity away from the reinsurance market, because if you can get 5, 6, 7% risk-free investment returns, why would you put money into a 5% cat bond?
Did you end up reading my book?
Cover to cover in about a day.
Okay,
I have to say I couldn't put it down. So I sat by the pool one Saturday, and by about 8 o'clock in the evening, it was already done. So
so
I very much plug this book if anyone's listening and they want to see a history of Puerto Rico, a history of the economic development in Puerto Rico as well. Highly recommended.
be good. Thank you.
We'll speak soon.
All right, bye-bye.